Welcome to This Explainer. Today, we're diving straight into a massive, looming collision in our economy. We are looking at what happens when historic government spending crashes right into the new Federal Reserve's plan to officially turn off the money printer. If you've been feeling the pinch of inflation lately, or you're wondering why the stock market is behaving the way it is, well, stick around, because we're going to connect all those dots for you.
To really understand what's about to happen to the broader economy, and more importantly, to your wallet, we've got to start with a truly staggering number, a $2 trillion annual deficit. To put that kind of massive scale into perspective, if you spent $1 every single second, it would still take you over 31,000 years just to spend $1 trillion, and we're talking about two.
Section 1. The trillion-dollar deficit.
Let's look at why this specific deficit dictates everything from national inflation right down to your monthly mortgage rate. Looking at the 2026 U.S. government budget projections, the math is as simple as it is alarming. The government expects to collect about $5 trillion in taxes, but they plan to spend $7 trillion. That creates a massive $2 trillion gap. And, just like you or me, when the government spends money it doesn't actually have, it has to borrow it.
To cover that huge gap, the government issues what are called treasuries. At its core, a treasury is really just a fancy word for an IOU. It's simply a loan made to the United States government, which they promise to pay back to the lender later with interest.
Section 2. Who buys America's debt?
So, since the government desperately needs to borrow an extra $2 trillion every single year just to keep the lights on, who's actually lending them all this money? Well, there are three primary buyers. First, you've got private entities. Think banks, pension funds, and everyday investors. Second, you have foreign governments, like Japan and China. And finally, when those first two groups just don't buy enough, the Federal Reserve steps in to fill the void.
Section 3. The stealth money printer.
Now, that third buyer, the Fed, that is where the whole system gets incredibly fragile. The reality of the Federal Reserve is that, despite the name, they aren't some traditional bank sitting on a giant vault full of cash reserves. To buy these treasuries, they literally create the money out of thin air. And whenever you print dollars without creating new wealth to back them up, it inherently devalues the dollars already sitting in your checking account. That directly drives up the price of your everyday groceries, gas, you name it. You might hear some highly complex central bank jargon thrown around in the news to describe this. For example, former Fed Chair Jerome Powell claimed recent printing was just reserve management purchases to support banks, rather than the quantitative easing we saw back in 2020 to stimulate the economy. But listen, the jargon doesn't change the underlying math. The intent might be different, sure, but the inflationary mechanism of creating money out of thin air, it remains completely identical. It all leads right back to inflation.
Section 4. The new Fed chairman.
And this brings us to a major upcoming catalyst that's going to shake up this entire system. The incoming Fed chairman, Kevin Warsh, appointed by President Trump, is stepping into the role with a very specific stated agenda. He has explicitly outlined his intention to stop printing this money. He wants to actively shrink the Federal Reserve's balance sheet by selling off treasuries. Basically, he wants to firmly turn the money printer completely off.
But remember that $2 trillion gap we talked about earlier? If the Fed stops buying government debt, somebody else has to step up to fund that deficit. And that deficit contributes to a total, mind-boggling national debt that currently sits at $39 trillion.
This $39 trillion burden is absolutely crucial to what we're talking about today, because as that mountain of debt grows, just paying the interest on it becomes the government's fastest-growing expense. It is literally far surpassing what we spend on the military or healthcare. Every single time interest rates tick up, billions more of your tax dollars go strictly toward paying interest rather than funding any actual services.
So we're basically staring down a perfect storm. At the exact moment the new Fed chairman wants to step back from lending to the government, our major foreign lenders are doing the exact same thing. China is actually becoming a net seller of US dollars, and Japan, which has traditionally been our largest foreign lender, is actively reducing its treasury purchases right now.
Section 5. 3 potential economic scenarios.
So, with the Fed stopping the money printer and foreign governments buying way less, the entire burden falls squarely on the private market. Based on the source material, this leaves us with 3 potential economic domino effects. In our first scenario, which is the absolute best-case outcome, private demand miraculously surges to buy up the debt. If that happens, interest rates are forced down, mortgage rates fall, business loans get way cheaper, and the stock market experiences a massive boom. In the second scenario,
Private demand perfectly replaces the void left by the Federal Reserve. It's a completely clean handoff. This would leave interest rates, mortgages, and the broader economy essentially unchanged. However, because the Fed has finally stopped printing all that new money, we would likely see inflation organically begin to cool down.
But here's the third, and frankly most dangerous scenario. If private demand fails to show up, the government is still desperate for that $2 trillion. To attract buyers, they're forced to drastically raise interest rates. And when Treasury rates spike, your local bank raises your rates too. That directly causes your mortgages, your car loans, and business loans to spike, which chokes the everyday economy and ultimately crashes the stock market.
Section 6. Protecting your wealth.
With all these massive macroeconomic dominoes falling, how does this actually impact your personal financial strategy? Well, the source material highlights a pretty uncomfortable truth. In our current system, simply relying on your paycheck and a traditional savings account is a mathematically guaranteed way to lose purchasing power. Standard savings yields just cannot outpace the relentless, hidden tax of inflation that's been caused by decades of money printing.
To survive and actually thrive in this system, the data suggests a necessary shift in your mindset. You really have to move capital into assets that historically weather inflation well. The source material points to a few major avenues for this: investing in the broader stock market, acquiring hard assets like real estate or physical gold, or utilizing alternative tax-advantaged accounts like the newly proposed Trump IRA.
The overarching theme from the sources really boils down to this one idea. You have to be an investor in this economic system to be able to win. The sheer machinery of deficit spending and central banking dictates that only those who proactively invest their wealth will be able to protect it from the constant ongoing dilution of the dollar. So as we all watch the new Fed chair navigate this terrifying $39 trillion tightrope over the coming months, I want to leave you with this final thought. Ask yourself, what happens to your hard-earned savings when the government's money printer suddenly stops? And are you properly invested right now to survive whatever the outcome is? Thank you so much for joining